Chapter 16, we continue to use our time value money keys, and we continue to use the PMT key. Now we're going to deal with loans. So we'll start with installment loans, then personal property loans, then mortgages. And the key to this is you kind of have to map out what happens with the loan. So we've got some different terminology. Our total installment costs is how much total cash out of your pocket. So if you go buy a car and you put $1,000 down, they tell you your monthly payment is going to be $300 for 60 months. That is, you're going to take the down payment, the $1,000 you put down, the $360 per month times the 60 month, and that is your total installment cost. That's how much it's going to cost you to buy that car. It includes the interest or the finance charge. So our financed amount is the amount that we need to purchase the car minus our down payment. So say we're buying the car for $15,000 and we put $1,000 down, we're going to finance $14,000. Our finance charge is the difference. So if we look at our total installment costs and we actually compare that to the amount that we're paying to buy the car, so not necessarily the financed amount unless we don't include the down payment above. So I guess that depends. If you didn't have a down payment, it would be the total installment cost minus the finance amount, which would be your total payments times your monthly payment minus how much you borrowed. Or if you're including the down payment, then you'd have to go to the amount that was needed to purchase the vehicle and then subtract that from your total installment costs. We really are going to solve the majority of these problems using our time value of money keys. And again, we're using the PMT key. It's a little bit different now because it's the monthly payment of the loan. So just get used to that monthly part. So none of these, like if we're making a car payment, we don't make an annual car payment. We all would have our cars repoed if that were the case. We make monthly car payments. Same with our mortgages. We don't make an annual house payment. We make monthly house payments or mortgage payments. So everything normally in this chapter, every once in a while, if it's a business loan, it might be quarterly, but the vast majority are monthly. So then get used to saying, okay, my N is going to be the number of months in that loan. My IY is my monthly rate. So take the annual rate and divide it by 12. The present value is always, always, always the amount that you borrow on the loan. So you're borrowing it today. So that's a common mistake for students. Again, they flip-flop this present value and the future value. So if you can just study and get it into your brain, the amount that I borrow on the loan today is my present value. The future value of my loan is 0. After I make 60 payments on my car loan, it should be all paid off. After I make 360 payments on my mortgage, the loan should be all paid off. So, I mean, it always surprises me, but honest to goodness, students will miss this probably 30% of the time. That's maybe a third of the time. They will flip-flop the present value and the future value, and they put the amount of the loan as the future value, no present value, and then compute the payment. That's a whole different scenario. That's like back to chapter 14 where we're saving for something. This is a loan, we're paying it off. We start with the money that we owe today and we slowly pay it off until it gets to be 0. Then we're going to move on because with most loans, they prepare an amortization schedule. So what the amortization schedule does for you is it takes each payment that you make to the bank and splits it out to say how much out of that payment goes to principal, which reduces my loan, and how much goes to interest, which is just income for the bank. And back when I got my first car loan, within my loan paperwork, it gave me an entire amortization schedule for the entire 60 months or 48 months, whatever it was, payment by payment. They don't do that anymore. At least the ones that I've gotten recently don't show you that. They'll show you the total interest you would pay if you didn't pay the loan off early. But basically what we're going to do with our financial calculator is kind of build an amortization schedule where you really could do each payment for the entire life of that loan. So the key to it is the first step always is to use our time value money keys, that I have circled here, to figure out what is my payment on this loan. So again, how much should I borrow today? How many months is it? My monthly rate, zero is my future value. Compute that payment. Then don't clear your tables out. Go right into your second menu button and then hit the PV button, and that takes you into this amortization function. AMORT is the abbreviation for amortization. And then when you go in there, this is the first screen you'll see. It pops up, our P1 is equal to what? So our P1 is saying our payment one. So if we want to isolate one payment at a time and build that amortization schedule, our P1 is 1. We're going to push enter, arrow down. Our P2 would be 1. We push enter, arrow down. And then these fields here are going to just be displayed for you. The calculator figures those out and says, okay, after you make one payment, this is your balance on the loan. This is how much out of that payment went to principal, and this is how much out of that payment went to interest. You could also do a range. You could say, well, I want to know how much interest I pay for the whole year. Whoops. Your P1 could be 1, and then your P2 could be 12. And then your balance would be, what is it at the end of the year? How much principal did you pay in those 12 months? How much interest did you pay in those 12 months? So you can isolate that any way you want to, or any way that the problem asks you to. So again, now here's an example. Say we have $15,000 needed to purchase a boat. We get a 3-year loan at 12%, find the payment, and then amortize the loan. So our first step again is our time value money keys. Our N is the 36 months. Our IY is the monthly rate of 1%. The present value is what we borrow today, $15,000. Future value 0, and then we compute the payment. So that says, okay, we'd have a monthly payment of $498.21. We hit our second menu button, the PV button, which takes us into that amortization function. And then if we're building the amortization schedule, we would isolate one payment at a time. So our P1 is going to be 1. We hit enter, arrow down, takes us to P2. We push in a 1, hit enter, arrow down. Then the calculator again is just going to provide these answers. So our balance after we make one monthly payment goes down from $15,000 to $14,651.79. That is a principal reduction of $348.21. The remainder of the amount goes to interest, which is $150. So if you added these two together, the principal and the interest, that equals your payment, because again, we're breaking this payment into principal and interest. If you took the loan balance and you subtracted the principal payment, that would give you this balance. So again, it's, it all is just kind of breaking it apart. And then you would move on to payment 2, and you'd make your P1 equal to 2 and your P2 equal to 2, and then you'd look at it. And you would do that for however many times that you need to. Okay, then our mortgage. The mortgage computations is the same as any other loan except for they're longer. They are going to be like 10 years, 15 years, 20 years, 30 years. Normally 15 and 30 are the two most common if you're really getting a loan. The thing that we add to our mortgage payments is our property taxes and our insurance. The banks require that to go into escrow. So normally what the problems will do is they're going to give us an annual amount and an annual amount for property taxes and insurance. And we have to take those annual amounts and divide them by 12, turn them into a monthly amount, and that monthly amount is going to go into escrow, but it's going to be added to our mortgage payment. So if you've ever looked for a house online, a lot of times the little ad will pop up and say, oh, your monthly payment will be $398. And you're like, hey, cool, I can afford that. But then when you add in, well, what's my monthly property tax allocation and what's my monthly insurance allocation, then you'll find out, oh, wait a minute, it's more like $700 a month or something like that. So just know that those are going to be included in the mortgage payments. And that finishes all of our concepts for test 3 and how we calculate using our time value money keys.